All right, good morning, traders. This is Taylor, and we're kicking off the pre-market prep here for Wednesday, January 5th. So I hope 2022 is treating y'all good so far. Quick look here at the futures. Your S&P 500, pretty much dead flat here, so I think a bit more of the same. So you kind of look back towards last week. You get that huge rip into Monday, and ever since we're pretty much chopping here. Just remember, we're chopping inside a really good structure. So you have a weekly squeeze, you have a 3-day squeeze. So we're not really going anywhere just yet, but it's all good structure. So I think the key here as far as trying to gauge the next move is for your S&P, I would kind of look at your AEMA here to continue to be support. But support is one thing. You need something to get you going off of support. So what you could do is dial it down to, you got a great looking 4-hour squeeze here. But the thing is, we're not going to go anywhere to the upside or to the downside until that 4-hour squeeze fires. And you could kind of take it all the way down to the 60-minute squeeze. And maybe that can trigger the 2-hour, maybe that triggers the 4-hour. My thinking as of right now is, we're in a bullish trend. We have bullish structure. I would look for that 4-hour squeeze to ultimately fire to the upside. Now, in the event it fires to the downside, I think you're getting a pretty good buying opportunity there back at the 21 EMA. Your QQQ here is down about 0.5% this morning. I love the structure here still. So you have your weekly, 3-day, daily squeeze, and a couple lower time frame ones as well. There's a 60-minute, a 30-minute, but it's good structure. Right? You're trading near your buy zone. You get stacked DMAs and a positive histogram. So I think the Qs look pretty good here. Let's check the Dow. Dow is kind of flat, but this is pretty much, at least this week, this has been your leadership. Right? So what they did yesterday, to some extent, right? A little bit of selling yesterday in the semiconductors. They finished the day down like 0.5%. So that's still a great looking chart. But there's a little bit of selling yesterday in the semis. There's a little bit of selling yesterday, in the tech names here. And all that cash is hitting energy. The energy is at a brand new all-time high. You're seeing a lot of that cash rotate into the financials. So, I think in an instance like this, don't really go, don't chase the hot commodity. Instead, focus on your setup and your structure. So financials and energy, that might be, the flavor of the week here, so to say. But that's not my entry up there at plus 2 ATR. So instead of chasing those, that I'm going to continue to do, let's look at something like the semiconductors here. You're down 2% yesterday at the low of the day, but nothing changes as far as the structure. So 5 days ago, it's a bullish daily squeeze. It's the same thing right now. So you got your stacked DMAs, all that good stuff. So instead of trying to, chase the financials, chase the energy names, I'm just going to continue to focus on my setup, which is going to be that bullish daily squeeze with an entry here near the 21 EMA. So that's a game plan for now. Keep focusing on the semis. I think the home builders here, that's a really good trend, and you got all the momentum. So the home builders are interesting, and I continue to think the QQQ and the XLK, they hold structure really well. So as long as you hold structure and you got your stacked EMAs, the squeezes tend to fire in the direction of that prevailing trend, which, as we all know, is very much to the upside. But one thing I want to talk about this morning, pretty much every time we do this together, we're talking about setups, we're talking about trade ideas. So pretty much means we're always talking about the squeeze. Want to talk a little bit more about, how can you structure a trade to effectively trade the squeeze? So kind of, the key thing here is, when you focus on a squeeze, and you focus on trading squeezes in the direction of trend, and then you have all the other characteristics, a positive histogram, positively stacked DMAs, green 10x bars. When you can really dial in and focus on the best of the best as far as squeezes go, you're going to be able to work about a 70-75% win rate. Now, the key with that is how can you maximize that? How can you fully take advantage of a good win rate? And the key is to have a good risk-reward ratio. But a few major things you want to keep in mind, in terms of trading the squeeze, and this is kind of, this is why I like to sell spreads versus buy calls. You might have taken a swing position here on the QQQ. all that's kind of done here is daily squeeze, or the semiconductors, for example. I'm not making the move just yet, but for the last month and a half, it's been a beautiful setup, right? It's been a really good structure. But if you're coming in here and you're buying those out the money calls, it can continue to be a great setup, but you're just taking all that premium decay. So the key thing here, a few key things, is at least with trading the squeeze, one thing we really want to be able to do is build our position, but then hang on tight inside of that +1, -1. That's what you're looking for from a squeeze. Until it fires either which way, you're going to get +1, -1. So I'm not really a big fan of taking losses inside of 1 ATR and -1 ATR. But from another perspective, I'm also trying to get my bang for my buck when the trade works. Right. So just one example here, kind of get you thinking. To me, a really good sweet spot in terms of risk reward, because we could certainly structure trades where we're going to risk 1 to make 5. And while that sounds good and that's always solid, the better the risk reward, the lower the probability. I think the sweet spot is, again, you're going to try to work that 70-75% win rate with a really strict focus on the right setups. But if you can work that 70-75% win rate with about a 1-to-1 risk reward ratio, and if you can do better than that, it's even better. But just kind of, bare minimum. If you can work these squeezes risking 1 to make 1, that can become really powerful. But I want to show you an example here of, again, where I think you can find that sweet spot. So we did a trade yesterday in my mastery here in the QQQ. It's a January 28th put credit spread, and we sold the 400 puts. So the short strikes are a little bit in the money here. More importantly, though, is the risk reward. Right? So in terms of targets here, when you're trading the squeeze, typically the upside target is going to be about 2, maybe 2.5 ATR. So kind of at a bare minimum here, my initial target on the QQQ would be about 410. So you got your target to the upside. That's the move you're looking for should the trade work. But then in terms of managing the risk, right, I don't want to get shaken out here, and I don't want to take my loss, right? So if I can make $500 up here, I don't want to end up losing 500 on the close under the 50. Right? I don't want to have to try to work that 1-to-1 risk reward ratio where I'm taking exits inside of the chop. Right? So to think a little bit bigger picture here, I think the Qs are solid all the way down to the weekly 21 EMA. For some context, it's been key support for the last 2 years or so. So to me, you're in an uptrend here as long as you're trading above that 21 EMA on the weekly chart. It's down there at about 383. So based on structure, in my experience, this has the kind of characteristics of something where if you take 100 trades and it looks exactly like this, 70-75% of them probably work in your favor. That's just one component, though. The second component is, can I put myself in a position where the odds are stacked in my favor that the trade is going to work? But can I ultimately work at least a 1-to-1 risk reward ratio between my upside target and between my exit? Meaning, can I make $500 per contract up here and only risk about $500 per contract on an exit under 383? Right? And to me, that's a sweet spot. It's a high probability setup. We're working a good risk reward, but we're working that without having to get shaken out in a bunch of irrelevant noise. In other words, the bigger picture structure basically has to shift here for us to have an exit. So the trade that we did yesterday, we'll look at it on the Analyze tab. But January 28th expiration, 400 short put. So it's a slightly in the money put credit spread and a 398 long put. So if we were looking to say next Friday's expiration, right? So January 14th, next Friday's expiration, the Qs are just cranking down here to 383. So it's kind of looking like this trade's not working. We might have to jump ship here if we want to work that risk reward. Well, January 14th into about 383, you're down 650, 700 bucks. And this is on 10 contracts. So per contract, you're down 65, 70 bucks. So there's our risk down to the weekly 21 EMA. So if this trade doesn't work into next Friday, we're losing about 65, 70 bucks per contract. Now, this trade sucks if the profit up here at 410 was like $20 per contract. We don't want to risk 70 to make 20. At a bare minimum, we want to risk about 70 per contract to potentially make 70 per contract into our target. And keep in mind, if into expiration, the Qs are just trading above 400, you make a little bit more here. So we're not really too concerned with trying to get max profit. And I think this is one of the bigger mistakes that folks make with credit spreads. Credit spreads can be great to kind of bring in some income. You kind of plant your seed and you just kind of keep the position open. Start to look at credit spreads more directionally. Right? So we're risking about 70 bucks per contract down around 383 with an initial target here of 410. If we're hitting that target into January 14th, we're up about $70 per contract, a little bit more. So to me, it kind of like a ground level here. This is a good trade. It begins with the setup. And again, it could be the Qs, right? It could be Ford recently. It could be Dollar Tree. It's just, that structure, that momentum, and that trend. So if your next 100 trades can have these, can have this list of characteristics, you're going to work a good win rate. But along with a good win rate, you want to have a good risk reward. So to me, this qualifies as a good trade. We're taking a good entry, and the Qs could roll over and die, but as of right now, it has a good structure, right? Indicators line up, and we can work a really nice risk reward here with an upside target that's pretty reasonable, right? 2 ATR to the upside, but we're not getting shaken out, right? This really has to break down. Essentially, put it this way. We're working a 1-to-1 risk reward ratio here where we make money if the squeeze fires long, and pretty much we lose money here if the squeeze fires short. So we're able to work a 1-to-1 risk reward ratio, taking a bullish squeeze in an uptrend, and we take our L here if everything kind of reverses and the squeezes start to fire short. It could happen, but I like the probabilities of trading a bullish squeeze in an uptrend. But more and more, we want to think about just kind of like flipping that coin. So if every trade we could structure had these characteristics, if we're working the right entry, but then based on, strike selection, based on time till expiration, if we can structure a trade where with an appropriate upside target and a good downside target, again, we're not trying to get shaken out on back and forth noise. If every trade we could structure is like this and we can work that 1-to-1, to me, the next component, and this is really something I'm trying to add to my game this year, is frequency of opportunity. So I'm guilty, I'm sure maybe a few of you are guilty of picking favorites. Now, if you look at Chandler, for example, Chandler day trades. I think as a day trader, you might want to have a few favorites, right? You really get familiar with key levels. You really get familiar with, options pricing, etc. As a swing trader, though, it's about the setup. So I think I'm a little bit guilty of, I like my big tech. It's kind of what I grew up trading. Right? I like the big semiconductors, the NVIDIAs. Quite frankly, though, Microsoft looks okay right now, but Dollar Tree, it's not big, sexy tech. Well, Dollar Tree is picture perfect, right? And if you look at the last handful of weeks here, like the list kind of goes on and on as far as, hey, if you can look for that moment in time, right, that really dialed in setup, like everything is coming together. And if you can look for that outside of big tech, big semis, outside of your favorites, there's a really big plate of opportunity out there. And I think I'm guilty of ignoring way too much of that. So if you look at, let me see if I can find this. Yeah, we could probably look at this one. There's probably a few in here. Okay. So these are scan results from the scan I'm running right now. And I ran the scan here on December 27th. So kind of give us a good, snapshot here of just some of the opportunity that there has been. Right? So Qualcomm hasn't fired yet, but that's a great setup. LRCX. So you're getting your buy signals back here. So here's a good example. When I'm thinking semiconductors, just by default, I'm always thinking pretty much NVIDIA, AMD. Well, AMD is just chopping right now. NVIDIA is just chopping. But LRCX over here is giving me my buy signals 1, 2, 3, 4, 5, 6, 7, 8 days in a row before it makes the move. Obviously, there was Ford. Realistically, if I'm on top of my game and doing my job, we're trading Ford back here in the weekly squeeze, right? So I love the Apple trade from a few months ago because Apple's in an uptrend and there's a weekly 3-day daily squeeze. Well, Ford was the same setup, right? And it's not always going to move like a big tech stock, but hopefully you get where I'm coming from. Is a swing trader, right? Just kind of keep it simple. If you can work a good win rate, right? And again, the win rate comes from focusing on only the best setups and just completely ignoring anything that doesn't, fit the bill. But then the second component, and this is where I'm making a lot of improvements, is working that good risk reward, right? So if you could work those numbers, then the next thing is I need those opportunities. Right? I can't sit here and just wait around until Apple or Facebook or whatever stock I might like trading is giving me that high probability moment in time. So I don't know what KLAC is, but I like bullish daily squeezes on a move into 2ATR. There's XLK, there's Digital Realty, Hewlett Packard. Still got some Dollar Tree. So again, with the semiconductors, get your buy signals there. There's VeriSign, there's Tractor Supply, Domino's Pizza. So I'm kind of laughing at the Domino's Pizza, on the scan results. Like, yeah, that's what I want to trade, Domino's Pizza. That's the wrong mindset. It's the wrong mindset because what this really was right here was probably an opportunity for me to come in and probably put myself in a position where there's about a 70-75% chance I'm going to make a point here. And if it didn't work, then I'm probably going to lose about a point. Just trying to get as many under my belt as I can. So a bit of a different discussion this morning, but hopefully gives you a few things to maybe take into consideration. And we'll be talking about this a bit more over the next few weeks. But going into the open here, guys, right, go through a few names real quick. Again, I like the semiconductors here, and I'll pretty much like them as long as they're giving me my buy signal. So just make sure you're not getting shaken out until something changes. A good example here of something that changed, was Datadog. Last week, Datadog's on the scan results, and realistically, we could have ended up taking a position here. Early buy signals, positive histogram, stacked EMAs. So it would have been a good trade. It would have been a good entry. But something changed here. I'm not getting buy signals anymore. We don't have stacked EMAs. Histogram's losing momentum. You're under the 8. You're under the 21. You're under the weekly 21. So maybe Datadog bounces back with a vengeance over the next week or so. But something changed, right? The setup that it was back here, when it got you into the trade, it's no longer that setup. Currently, you can't say the same thing about the semiconductors. Even going back 3 weeks ago. If anything, it looks better now as momentum really starts to shift. So, like I talked about in last night's video, I think that's important. Ask yourself, has anything changed here? I think the semis look good. I think tech, at least as of right now, continues to have good structure. I want to do something with Google here. I don't quite feel the need to rush. I think with anything on Google right now, you're very much in chop. It's all in the context of a really bullish trend, but you're trapped in a bunch of squeezes right now. You're trapped in your weekly, you're trapped in your 3-day, you're trapped in your 2-day squeeze, and you're trapped in your daily. So, here's what can get really difficult with something like this. Is you're going to come into today's session, you're going to look for, a 60-minute squeeze, and you're going to try to nail some nice directional move. That's really tough. Like the lower time frame, the shorter term trades are really tough. When you're really just in +1, -1 mode, right? Build up of energy mode, where those trades on a 60-minute chart are a little bit easier is something like Apple, for example. Right. You finally break out, you get into trend. When you get into trend, well, then one of the best things you can do if you're a shorter term trader is wait for a 60-minute squeeze, or my preference, wait for a 4-hour squeeze. There's your entry. We're taking profits on Apple a few days ago with that mindset. But something like a Google, you're not quite in short term trend just yet. I think you do here to structure something again, right, where you can work a good risk reward, but I go all the way out to like February, maybe even a little bit further, maybe March. Give yourself the time here to let that squeeze. Trying to nail the next move on Google for the next 4 to 5 days, that can just be tough, right, when you're really range bound. What can be a little bit easier, though potentially a little bit more difficult, mentally and emotionally, is just take the weekly squeeze, build the swing position, right, scale into it, but give it all the way until February, March, right? And kind of let that thing play itself out until that squeeze finally fires in your favor or against you. So not the easiest, patience-wise or discipline-wise, but in terms of trying to work a trade here, I do think for now that's an easier trade. So just keep that in mind with the big goog there. But Microsoft is pretty solid. I'm not getting buy signals just yet, but you're getting pretty close there. In terms of Apple, I don't really see the next trade here just yet. You somehow have a daily squeeze, which that's a little bit odd. That's actually a bit odd. And you got a 15-minute. I think that back there was the easy trade. And then your dip and then the push into that 183-ish. I think that was the second easy trade. I'd like a 2-hour or 4-hour squeeze. A little bit more here to work with. Let's see what else is out there as far as tech goes, right? In terms of Facebook, no buy signals for me here just yet. And then in terms of Amazon, no buy signals here either. So with both of those names, right? Both Facebook and Amazon. So they're both in weekly squeezes, right? So they have that in common. But what they also have in common right now is they don't really have that momentum. It supports the idea that, we're going to wake up tomorrow and very quickly here the weekly squeeze is off to the races. You can look at the histogram. You can look at the fact that, you're under the 21 EMA. You can look at the lack of stack moving averages. Google on the weekly chart here is far, far superior. It could very well chop for another month and a half, but just keep that in mind. Right? Not all squeezes are created equal. So Google on a weekly chart, I think looks a lot better than your Facebook or your Amazon. But that's what I got, guys, as far as tech goes. As far as the semis go, um, yeah, to me, I try to keep it simple. I'd rather not chase a Micron, though I think Micron probably grinds higher. I'm a bit more interested in a Qualcomm, a bit more interested in just SMH itself. I think there's NXPI, which is rock solid. Right? That looks really good. Then AMD, as long as I keep getting my buy signals here. Right? I prefer to take the entry in something still squeezing versus Micron versus Broadcom, where for me, the easy move has already happened. Probably trades higher, but the easy move has passed here. And then a few more setups kind of outside of tech and semis here. Home Depot looks rock solid. I'd prefer to pick it up a little bit closer to the 21. So here's another discussion for another day. Trying to work that 1-to-1 or better risk-reward ratio with credit spreads, you really, really, really have to work your entry at the 21. Okay? And depending on how much premium there is, you can work that 1-to-1 up here, +1 ATR, but everything just gets better in your favor the closer your entry is to the 21. So if Home Depot could dip here, which I don't think it does, but if it could, I'd like a little bit. I'd like some of Lowe's. BJ has a pretty solid daily squeeze here. Then you got your new core, pretty solid. But there's a lot of good looking names out there right now. So I think it's just a matter of which ones hold structure and then ultimately which ones finally get this job done. Ford here, just total beast mode. I thought we had a pretty good exit there. What was that, another $5 or so? But that's what I got, my friends. Answer a few questions here real quick, and then I gotta run a quick errand before the open. Eric, I think slab is a great setup. So another one for me where I got to trust the indicators. Right? The indicators they're smarter than I am. Right? They don't really have opinion or bias. So typically for me, I'm going to look at slab and say, well, I don't know what Silicone Laboratories is, so I'm not interested. Like, this is everything I look for: trend, structure, momentum, weekly, daily stacked DMAs, green 10x bars, daily squeeze down to a 30-minute squeeze. Picture perfect. So my goal is to stop ignoring stuff like this. And believe me, when Amazon has a beautiful daily squeeze or Apple, I'm going to be all over it. But that fits the bill. That definitely fits the bill. Robert, how's AMAT looking? Yep, there's another solid semi. You dip back to the buy zone yesterday. They pick it up pretty quick. So I think that's a good example. Keep in mind, you could take Micron. What you do here is look for that 8 EMA to be support, and then you're trying to build an entry based off a lower time frame squeeze. So like your 2-hour squeeze here, if you're looking for Micron to continue to push higher, that's where you want to look to build your entry. And then just think in terms of options pricing. If you buy those calls as it's exploding, you're kind of overpaying. So that little bit of consolidation kind of brings down your IV. Your calls get a little bit cheaper. You could look for the next push, and you could probably do the same thing there on Broadcom. But AMAT, Qualcomm, SMH, they're more so you're building a position, looking for the squeeze to fire. Micron and Broadcom, they're pretty far into the squeeze firing. So you kind of look at those as continuation trades where the semis here you probably look at more as like a consolidation trade. This might keep chopping and chopping and chopping and chopping, but ultimately you're looking for that squeeze to fire in the direction of the trend. Let's see, Angela, you got a Tesla January 21st, 1,000 strike put credit spread. Very nice. Very nice. So good question, Angela. Let me put this question up on the screen. So here's my question for you. And let me know here in the chat, do you have any other setups on your watch list right now that look actionable? Meaning, is there a better use of your cash right now versus trying to hold on for the extra 20% of max profit here? So the way that I would look at it is, if there's nothing else setting up out there, maybe I hold on a little bit more. But say on my watch list, I got things like Dollar Tree, things like Lowe's, things like the semis, etc., that are still in their squeeze. I'd probably look to take the easy money on Tesla and then deploy that into the next good setup that could bring you home another 50, 60% of max profit. Because it definitely is nice if Tesla keeps the move going here and you can cash out at 70%. If it ends up coming back in, so say the trade just turns into break even or it turns into a loser. But regardless, if it ends up coming back in, we want to look at that almost as lost opportunity cost. Because if you can take your 50% of max profit right now, that moves your account forward. But what it also does is, Mark Minervini talks about this in his books, it kind of finances your next trade. So say you make $100 on Tesla, well, now you can go over to something maybe like a Qualcomm, because Tesla's already made the move into 2 ATR. So maybe now you take your $100 profit and you parlay that into the next trade. And that trade's kind of paying for, the previous trade's kind of paying for the new trade. Get where I'm coming from? Okay, and you got some Amazon, Nvidia, Microsoft. Yeah, just a few things to consider there. In terms of Tesla itself, I mean, the thing's on crack, right? So this much we know. Here's what I do like, Angela. If this thing's legit, so what I mean is if it's really going to start that journey back into a brand new all-time high, might not happen immediately, but what it shouldn't do is start to trade back under the 21 EMA. And really what it shouldn't do is start to trade under -1, heading back down towards the 21 EMA on the weekly chart. So I do think you've got some good cushion here. It's $150 a cushion. So the probabilities probably point towards you end up getting filled here at 70% of max profit. But as a general statement, I do think a good way of thinking. And I'm guilty of this. I'll show you guys a few examples before I cut you loose here. And these are mistakes we got to learn from. So, I got the mastery into Netflix. Right, good entry. Right, pulls back, buy signals, get stacked EMAs, green 10x bars. Right, so good entry, good trend, and the thing gives us the move we're looking for. Now, I don't remember exactly what's going through my mind at that point, but probably something along the lines of, all right, guys, we're at 70% of max profit. Let's see if we can get Netflix here into 720. Maybe we can get 75, 80% of max profit. Now, what ended up happening here, as you can see, is Netflix dies out, rolls over, and on that bounce, we're buying the trade back for break even. Right? So no bloodshed. We didn't lose any money here, but what we lost was that opportunity cost. Might have not been 100% of max profit, might have not been 70, but we got the high probability move. So that little bit of greed, what it robbed myself of, was the ability to move my account forward. But more importantly, I could have taken the profits from Netflix and then opened up the next solid trade. So I don't think Tesla does this, but something to keep in mind at the very least. We'll go through a few more here, guys, but I got to hit the road here. Oh, wow, PNC, what's this? Big time move. For me, the kind of thing where if you got it back here to 21, cha-ching. But in terms of the financials here, guys, I see a few questions on those. But that's kind of my thought process here. Yesterday's move is great. It's great. If you're building your position inside either the daily squeeze or the weekly squeeze, for a guy like me who wasn't, doesn't really leave me with too much to do here, other than look for continuation trades, right? So with the Bank of America, for example, I'm just not going to come in here at 3 ATR and try to sell that 30-day till expiration put credit spread. For a few different reasons. It's extended. So it could easily rally to 50, but it is fighting that growing probability that at some point it's got to come in a little bit. And then in terms of options pricing, well, the calls are crazy expensive right now, right? Relative to call it fair value, and the puts have gotten crushed. So I really can't work a good risk reward. What you could do, though, is dial it down to a lower time frame, find your squeeze, and I kind of prefer a 30, a 1 hour, a 2 hour, but same principles. If you think the move's going to continue, your best entry is going to be in that break of the action. Right? And in that break of the action, that's where I think you structure a trade that makes sense. Right? And to me, a trade that makes sense here isn't something where if it does pull back a bit, you're going to lose your shirt. So maybe up here you're doing something like it could be a low risk, high reward, out the money debit spread. It could be an at the money put credit spread. could be a butterfly up at 49.50. Just acknowledge the fact that, hey, as good as this looks, any given day now, it could quickly come in a little bit. So that's where I think you structure, call it a continuation trade, where back here is where you structure a consolidation trade. Right? Way more time to expiration back here, giving yourself way more wiggle room, or just way more tolerance to sit through the chop. Up here, it's more so it either continues or you're going to jump ship. And you're really going to try to work a good risk reward. How about, is John Deere going too, Mayor? Yeah. So it's like everything I didn't like 2 days ago is the flavor of the week here so far. All right, last one of the day here, Gabe. Nucor. Got it going on. Got it going on. Weekly, 3-day, daily, 4-hour, 2-hour, 60-minute squeeze. So I love everything about that. Love everything about that. Not much I can say about it other than very solid. So to me, this would fall into the category of, hey, I just want to flip the coin here. I don't care if the trade works. I don't care if it doesn't work. I just think this could be a nice addition to, my book of, the next 100 trades I take, trying to work about a 70-75% win rate and trying to work about a 1-to-1, if not better, risk reward ratio. Like, more and more, we got to stop looking. I'm talking out loud for myself as well. We got to stop looking at our next trade as like the trade, right? Like, this is going to be the big one. Like, this is going to be the one that sets my year off right. Look at it no more than a flip of the coin. Right? Just imagine, though, that 70-75% of the time, the coin lands on heads and you get paid when it lands on heads. And the other 30% of the time or so, it lands on tails, but you're just trying to keep those numbers even. And so I think when you find something like this isn't make or break it. It's not do or die. This is just a good trade. But I'm going to cut you loose, guys. Market opens up here in a few minutes. We'll keep this discussion going. Let me see. Yeah, Chandler's on vacation this week. He'll be coming home back to Massachusetts tomorrow. But I'll be with you for the pre-market prep on Friday. So we'll continue the discussion then. Appreciate y'all joining in. Hope you found it helpful. For those of you over at Simpler, I got the 10:30 a.m. Eastern session, and then I'll be in the training room later on this afternoon. But I'll talk to you guys.